Hello, I'm Dave Gentry. Welcome to the RedChip Money Report, where we help you discover the best names in emerging growth stocks. Today, you'll meet executives from American Water Works, the nation's largest publicly traded water and wastewater utility, and IZEA, a leader in social media sponsorship. Now, we'll also feature a segment on our big cap stock of the week, and you guessed it, Facebook, symbol FB, on the NASDAQ. Our first company is American Water Works, symbol AWK, on the New York Stock Exchange. Market cap $6.5 billion, $2.84 billion in 12-month trailing revenue. Now, this company qualifies as a mid-cap company, a mid-cap stock. The forward annual dividend yield of 2.7% trades at around $38 of the 13 companies covering the stock, the 13 research houses covering the stock. 6 give it a strong buy with a mean target of around 41.50. Founded in 1886, the company provides water and wastewater services in more than 30 states. They own or operate 80 surface water treatment plants, 500 groundwater treatment plants, 1,000 groundwater wells, 100 wastewater treatment facilities, 1,100 treated water storage facilities, 1,200 pumping stations, and 90 dams, and 46,000 miles of mains and collection pipes. Now, your company was recently recognized for your patented NP Express wastewater technology. Tell us a little bit about the technology.
Well, we have an in-house innovation development program that seeks to leverage our expertise and size to research and bring market innovations that benefit the industry, the company, and of course our customers as well. So one of the innovations that came out of this program is our NP Express wastewater treatment technology, which is a more affordable and sustainable method to remove nutrients such as nitrogen and phosphorus from wastewater. The importance of this technology is that removing these nutrients, which is really a requirement in various watersheds across the country, has traditionally been a difficult and costly process. It involves a large amount of energy and the addition of extra chemicals. Our NP Express process uses significantly less energy and significantly less chemicals, and that translates to cost savings for the process and is better for the environment as well.
You're now in the process of launching homeowner services in New York City. How's that initiative coming along?
Well, our homeowner services business, American Water Resources, was selected by New York City Board as its official service line protection provider for homeowners in New York City's 5 boroughs. So our offering fills a gap in the protection of our customers. And this service will be offered through the city's water board, with the information coming with the customer's water and sewer bills beginning the first quarter of 2013, and we're really excited about this service.
We've got thousands of retail investors that are viewing the show today. Tell us why they should be interested in building a position in your company.
We don't need to create a widget and see if it sells next year to make our yearly goals. By earning an appropriate rate of return on those regulated investments, we get close to that goal. The rest could come from acquisitions, expansions of our market-based businesses, and increased efficiencies, all of which help the bottom line. So if you like the notion of an investment that produces mostly stable, regulated returns with a stated goal of a low double-digit return and being involved in an essential infrastructure business in the U.S., you need to look at us, American Water.
For the 9 months ended September 30th, 2012, American Water Works generated net income of about $302.6 million, or diluted earnings per share of $1.70, compared to $244 million in the previous year, or diluted EPS of $1.39, again, for the comparable period in 2011. Income from continuing operations was $320 million for the 9 months ended September 30, compared to $244 million for the same period. Driving this 23% net income growth was price increases and greater demand in its regulated business division. I give it a buy rating. I give it a long-term hold. Again, great American company, been around a long time, still growing, good dividend. Put it in your portfolio. Now, let's hear from Jim Snarf, founder and president of Wall Street Strategic Capital. This is a strategic financial advisory firm that arranges capital for clients through a large variety of institutional funding sources. He's also a very good friend of mine and one of the smartest men on Wall Street that I know. Let's go to Jim Snarf.
This is Jim Snarf, president of Wall Street Strategic Capital, based in Orlando, Florida. And I'm here today to provide a quick update on the global capital markets outlook in 2013. The fiscal cliff resolution that was passed very recently by the U.S. Senate and House will provide some relief from the concern being expressed by all the different groups around the world. However, probably still a 1% drag on GDP in 2013. The net result will be likely growth that's very disappointing, perhaps in a moderate range of 2%, 2.25%. On the other hand, many emerging markets are going to see much more robust growth 2013 and probably into the following couple years. This will be led predominantly by China. We expect growth to be a minimum of 7% and based on exports and world demand potentially exceeding 8%. One challenge that China has faced has been a slowdown in foreign direct investment coming into the country. In addition, there continues to be an exodus of wealth moving out of China, particularly into the United States and Canada, and the country is taking steps to try and curtail that. The other thing that China has to focus on is continuing to increase its domestic consumption, because the country has relied on many years for growth in export markets, and that no longer is going to be able to be sufficient to sustain the levels of growth that China has become accustomed to. Other bright spots around the world, we expect certain Latin American countries to show robust growth. Mexico elected a new president, just took office in December. Tremendous amount of infrastructure and energy projects taking place in Mexico. Our belief is that we'll see a minimum of 3 to 3.5% growth, perhaps as much as 4% in Mexico in 2013. In addition, Brazil, though, reporting more than what I would call disappointing results over the last couple years, with growth being below expectations, is hosting the 2014 Cup, and 2016 will have the first ever Olympics in Latin America. We expect growth in Brazil to top 3%, perhaps approach 4% in 2013. Europe will continue to struggle. The overall belief is there will be a loss, a net loss in GDP, probably in the range of 0.5 to 1%, though at this point we're not expecting any significant defaults in terms of Greece, Spain, and Ireland. We think those problems will be worked out. Nevertheless, will continue to be a drag.
After the break, I'll give you my weekly book report, and of course I know you're thrilled about that, so stay with us. Welcome back. It's time for our Wall Street book review. Now, last week we looked at The Patriarch by David Nasaw. Today, Think and Grow Rich by Napoleon Hill, the landmark bestseller, revised and updated for the 21st century. Now, I read this book for the first time when I was 24 years old and selling copiers in Alexandria, Virginia. I've reread it several times over the last 20 years, and it's a great book, and it's a must-read for anyone who desires to grow rich. Now, first, I want to give you a brief background on its author, Napoleon Hill. He was born in 1883 in Wise County, Virginia. He started writing as a reporter for small mountain newspapers in southwestern Virginia. The book was published for the first time in 1937. He was encouraged by the steel magnate Andrew Carnegie in 1908 to establish the world's first organized scientific literature of personal achievement. Think and Grow Rich has sold over 15 million copies worldwide. It is the gold standard for motivational literature. Before he wrote the book, he interviewed 500 wealthy and very successful business leaders, thinkers, and entrepreneurs of his time. Now, you remember Benjamin Franklin's autobiography, which we previewed several weeks ago, which discussed the 13 principles of success. Well, Napoleon Hill also has 13 principles of success. And I want to take a moment and review these with you. If you want to think and grow rich, you must have desire, faith. Use the power of auto-suggestion, positive thinking, talking to yourself, explaining, sharing your goals. Specialized knowledge, you got to get to know your industry inside and out. Imagination, you got to be willing to take risks. You have to have an organized plan. You've got to be able to make decisions and persist in the face of adversity. And you have to have a mastermind. You must get around people that are thinkers and visionaries, and it can help you develop your plan and your dream. And number 10, the mystery of sex transmutation. I'll let you read the book to figure that one out. The power of the subconscious mind, the brain, and the sixth sense, number 13. The door to the temple of wisdom. Again, read the book to learn more about his basic principles here. Here's my summary of the book. Here's why I love it. Here's why it sold 15 million copies, because it sends this message to those who want to grow rich. You must have a vision of what you want to accomplish in life. We must learn to think positive, set goals, educate ourselves continuously, use the power of auto-suggestion, and seek to meet and socialize with people greater than ourselves. In the end, there is great power in positive thinking. We are the masters of our own fate. Only we can change our world. Discipline is imperative. Hard work is imperative. Knowledge is extremely important. Desire matched with education, persistence, and planning can lead to high achievement and riches. Read the book. Whether you're old, young, middle-aged, it will inspire you, motivate you. It'll teach you the principles you must apply to be successful and get rich. Principles that he learned from people like Henry Ford, Andrew Carnegie, Thomas Edison, and W. Clement Stone. The book is also updated with stories of how our contemporaries, such as Steven Spielberg and Bill Gates, became so wildly successful and rich. And don't forget the power of determination. Now, Carnegie tells the story of how Henry Ford created the world's first 8-cylinder automobile engine. His engineers told him it cannot be done. It's impossible to build an 8-cylinder automobile engine. They tried and failed over and over again, but Henry Ford would not take no for an answer. Every time they failed, he said, "Keep trying. I will have my way." The rest, of course, is history. Our next company, IZEA, symbol IZEA. It's on the OTCQB, not listed yet. This is a pioneer company in the field of social media sponsorship. IZEA helps social media influencers to monetize their presence, their social media presence, by connecting them with advertisers. Now, this market, which is called influencer marketing, has emerged as one of the fastest growing social marketing practices. And IZEA has created a strong foothold, having assembled a network of more than 850,000 influencers to date. This is a powerful force that has allowed IZEA to secure major advertiser relationships with the likes of GM, Kraft, Best Buy, Verizon, and many others. Now, here's our interview with Ted Murphy, the founder and CEO of IZEA, based right here in my home city, Orlando.
Hi, I'm with Ted Murphy, founder and CEO of IZEA Incorporated. Welcome, Ted.
Hi there.
Ted, what is social media sponsorship?
A social media sponsorship is the modern day equivalent of a product placement or endorsement. So if you think about what used to happen, you might be listening to a radio DJ and he may be talking about a product on the air, right? I love my McDonald's, or I love my Starbucks. We take that same concept and we apply it to social media. So we pay people to tweet about products, to post things on Facebook about products, or to even write blog posts.
Great. Ted, you've been reporting increasing profit margins and decreasing operating expenses lately. What's driving these?
Well, we've been in business since 2006, and a lot of the things that we've been doing have been to optimize our platforms. So when we first started out, our gross profit margin was about 26%, and that's increased every single year because we've been really tweaking our algorithms and decreasing costs wherever we can.
Ted, what's your current sales pipeline looking like?
We've got over $10 million in qualified opportunities out there, and that's between a mix of agencies and brands. One of the things that we're really excited about is for the first time we've crossed the mark of having a 7-figure opportunity out there. So advertisers are spending more money with us. They're engaging in larger contracts over larger amounts of time, and we're really excited about the future.
Great. Can you share with us, what are your growth plans, let's say for the next 5 years?
Well, we're really looking at the entire space. So we think that there's an opportunity to power a lot of the other platforms that are out there that are utilizing social media, and really to get into the sponsored action space. So we don't really care whether we're looking at a photo or a text update or a video. To us, all those are actions, all those are opportunities for sponsorships or endorsements. So we're looking at creating a broader platform that will connect into other platforms and really allow us to create scale at an even greater magnitude than we can today.
Right. Ted, to summarize it, why should investors take interest in IZEA today?
This is an exploding space. I mean, you can't watch a single commercial now without hearing somebody talk about follow us on Twitter or like our Facebook page or read our blog. And advertisers are trying to figure out how they could take advantage of the power of the people, right? 20 years ago, you could tell someone about a product and you may reach 5 or 10 people. Now you could have hundreds or thousands or even millions of followers through the social web. So we are at the perfect place right now. We've been developing these technologies for over 6 years, and we know that there's a tremendous amount of opportunity.
Great. Thank you, Ted.
Thank you.
Value proposition. IZEA reported 9-month revenues of $3.9 million for the period ending September 30th, 2012. Now that's an increase of nearly 40% over the same period in 2011. The company is growing. The company is also seeing improving margins, with its gross profit margin reaching 59% in the third quarter. They have a pipeline of about $12 million. They've laid a strong foundation for solid growth in 2013. Despite its impressive financial performance and future prospects, as a recent entrant to the public markets, IZEA has not yet hit Wall Street's radar screen. Stock's trading at 25 cents. But this is the opportunities that we like to bring to you before these companies show up on Wall Street's radar screen. The stock's trading at 25% of its trailing 12-month sales, with a market cap equal to its most recently reported cash position. It's unlikely to find opportunities like this in the markets, let alone one with a track record of growth in a fast-growing industry. I give this company a buy rating, again, currently trading at 25% of its trailing 12-month sales. When we come back, we'll look at our big cap stock of the week. Take a look at these recent Wall Street headlines for Facebook. Facebook leads into the year tech gains. Facebook reiterated a buy. Facebook underwriters remain bullish on company. Monday's biggest advancing and declining stocks at MarketWatch, Facebook. Facebook enters sophomore stock year with fewer skeptics at the street. BMO ups Facebook to buy. Stifel raises estimates, better attitude, better prospects. Facebook enthusiasm builds at the Wall Street Journal. Facebook stock rises after 2 analysts turned bullish at Investors Business Daily. The fiscal cliff won't stop Facebook from soaring. Motley Fool. So what happened? How did one of history's worst botched IPOs regain favor on Wall Street? Well, the underwriters want to recover some of their losses for their institutional investors and save face. Remember, the stock reached $45 on its first day of trading, then quickly was pummeled. And now Goldman Sachs, JP Morgan, Morgan Stanley, the 3 biggest underwriters, simply cannot continue losing money for their institutions. So they've issued 40 reports cumulatively, in all with buy ratings. Look at the headlines. Perhaps the most bullish analyst covering Facebook is BMO Capital's Daniel Salmon. He raised his target from $15 to $32. Now, why did he do this? We believe Facebook's advertising platform, and I'm quoting, is currently gaining momentum with both traditional brand advertisers and direct response, including a lot of e-commerce marketers, writes Salmon. Now, according to Salmon, advertising agencies once described Facebook as tone-deaf, arrogant, inflexible, but they're now willing to learn, and they are changing their advertising to meet the needs of their customers and their members. They're also very focused on their mobile platform. Revenues, $4.6 billion, 12 months trailing earnings, $524 million, 12 months trailing. Forward price to earnings ratio about 41. Subscribers over 200 million. That's more than the population of any country in Europe. Just buy Facebook. Get your face in Facebook. Face your portfolio towards Facebook. 3 years from now, 5 years from now, this is probably $100, $150, $200 stock. Facebook. We looked at 3 companies today: a mid-cap stock, American Water Works, a micro-cap stock, IZEA, and of course our big-cap stock of the week, Facebook. Now, IZEA is a RedChip investor relations and research client and currently pays RedChip a monthly fee. We also will receive about 200,000 shares of restricted stock over the next 12 months in compensation for representing the company. Conflict of interest? Some may think so. We love the company. We think it has great potential upside. Now, to learn more about these companies, visit us at redchip.com or email us at money@redchip.com. And remember, always do your own homework before buying any stock or consult with your financial professional. We cannot guarantee the performance of either the company or the stock, nor can we guarantee the veracity of all the statements made by the management team. Smaller cap stocks are the riskiest asset class, and while financial gains can be significant in both the short term and the long term, you should also be prepared for the downside. In closing, I encourage you to write to us with your questions or comments related to the stock market or any stock trading in the U.S. by emailing us at money@redchip.com and visit our website, redchip.com, and follow us on Twitter at RedChip Nation to learn more about our portfolio of small cap stocks. And you can also give us a call Monday through Friday at 1-800-REDCHIP, extension 0. Again, thanks for watching today at the RedChip Money Report. Stay tuned for our next show next week when we continue our search for the best names in emerging growth stocks.